Hello everybody and welcome to the 2 Levels Up channel. My name is AC and this is the Dividend Investing Series, Part 1. The information on this channel is for educational purposes only. Under no circumstances should the information outlaid before you be deemed, interpreted or acted upon as financial or investing recommendations. By watching our videos, it means you fully understand plus accept our terms and conditions. You are also agreeing to the fact that you're fully capable of making your own sound and critical analysis of the information provided. Dividend investing is a process of buying stocks in order to receive a regular income from your investment. Dividend investing is a long-term strategy, which means you must keep your stocks for the long period of time. The dividend payments you receive is a share of the company's profit. Dividend investors like to invest in stocks that pay large dividends in order to make money. There are 2 strategies for dividend investing. Strategy 1 focuses on high dividend yielding stocks. A high dividend yielding strategy focuses on mature companies that have substantial cash flow. This allows them to fund large dividend payments and produce an immediate income. While strategy 2 focuses on high dividend growth rate stocks. This offers investors long-term growth and profit. This strategy allows the investor to focus to buy stocks in companies that are in the expansion phase while currently paying lower than average dividends. What are advantages of dividend investing? Well, to keep it simple, if you hold a large amount of high dividend paying stocks, you will have a solid base of passive income, which can give you a regular income, which can be reinvested to increase your total dividend earnings if you choose. The best thing about this approach is you will still benefit from the capital appreciation. This is one of the ways you can make your money work harder and smarter. This also allows you to immediately increase your total dividend income, as well as secure a better long-term prospect regarding capital appreciation. But to be truly beneficial and for you to take full advantage of reinvesting your dividends, you must invest a significant amount of money into dividend paying stocks. The most important things to know about dividend investing are the dividend yield, the dividend payout ratio, the dividend coverage, and the dividend cut. One of the most important metric that you will be using in dividend investing is the dividend yield. To simply put this, a stock dividend tells you the percentage of the company's current share price that is being paid out in a form of dividends on a yearly basis. The dividend you want to pay attention to should outperform the dividend yield of the FTSE 100 by 50% if you're in the UK, and the same, but if you're in the US, it should be the S&P 500. You should always compare the company's dividend yield to its competitors and its industry where it operates in. What is a company's dividend payout ratio? Okay, once again, this is another important metric in which you must understand and allows you to understand the sustainability of the company's dividend policy. To calculate the company's payout ratio, we take the dividend that is being paid out per share and divide it by the company's earning per share. So is a high payout ratio better than a low payout ratio? Well, a high payout ratio are common with older established companies that are leaders in their respective fields. These leading companies or these large companies have a stable cash flow and have very little room for growth, so they can maintain a high payout ratio. While on the other hand, a low payout ratio is more sustainable and has the potential for increasing dividends down the line. It also tells us that a company is choosing to reinvest money, which could translate into growth and capital appreciation down the line. What is the company dividend coverage? A company dividend coverage is the inverse of its payout ratio. It is yet another metric that can help us gauge the risk of the investment in a particular stock. It is calculated by taking the company's annual net income and dividing it by the total amount of dividend to be paid. The dividend coverage is calculated using a net income and not the cash flow. A higher dividend coverages are a sign of a financially stable, mature company. And these companies tend to have higher dividend coverages and are generally seen or perceived to be more safer investments. A dividend coverage of 2.0 is considered healthy, and you should focus on these companies. A company's dividend coverage is liable to change, and if the dividend coverages dip below 2.0, you should pay extra attention to that company. When the dividend coverage does drop below 1.5, it is a strong recommendation and a strong warning sign that you should abandon the business in question and invest your money elsewhere. What are dividend cuts? A dividend cut means the amount of money paid out to investor per share is being reduced or outright eliminated. The dividend cuts are bad news. You want to avoid them altogether if possible, as they are a clear sign of the company's financial well-being getting worse. Dividend cuts most often occur due to reduced earnings or mounting debt to equity ratios. The reduction in the dividend cuts can cause investors to sell off their holdings, resulting in the share price to fall, and it is much more of a green perspective with regarding to capital appreciation. You should focus your attention on companies that have not had a dividend cut in years or even decades when building your portfolio. However, if a company decides to cut its dividend, you should take a good look at their future perspective and overall financial well-being before deciding to sell. Thank you for watching part 1 of the dividend investing series. Keep a lookout for part 2. Have a great day. Subscribe and like. Thank you.